markets have been hit very hard by the outbreak of the pandemic. The most severe strains were felt in energy markets, given the extent to which mobility has collapsed globally. However, the combination of a deflationary demand shock on the one hand with various supply shocks as a consequence of imposed lockdown measures has meant mixed effects for other sectors. As we approach the end of the year, most sectors apart from energy, in fact, have not only fully recovered, but are exhibiting significant gains. To a significant extent, this is due to the strength that the Chinese economy is exhibiting, which as the first major economy has fully recovered all GDP lost and returned to its pre-pandemic growth path. This has helped demand for industrial metals and agricultural imports, while demand for precious metal has been viewed first as a safe haven and then later as real rates and the dollar have declined. We see three major factors shaping trends across commodity markets over the coming year. First, the amount of capital expenditure across resource extracting industries has been insufficient to maintain production capacity for many years. This was driven by the cycle downswing as well as low prices. Now the pandemic has exacerbated this trend further as companies were forced to divert funds from capital budgets in order to maintain operations. As a result, we're seeing supply deficits arising across a wide range of commodities, and these deficits are set to deepen further. This is quite unusual for this early stage of the cycle that we are in. Secondly, there will be rising demand from politically supported stimulus and investment programs. Many of these initiatives are focused on the energy transition and entail metals-intensive investments in infrastructure. Third, there are macroeconomic tailwinds arising from continued dollar weakness and, in our eyes, rising inflation risks. Given the tremendous financing needs of record dual deficits in the budget and the current account in the United States, we expect to see pressure maintained on the dollar over the coming year. With respect to inflation risks, while consensus opinion suggests that there is little risk of rising price pressures in the near term, unlike 10 years ago, when similarly loose policy proved unable to generate inflation in the real economy, this time around it's not just monetary policy, but governments are spending as well, and unlike then are not pursuing austerity programs. Fiscal spending and deficits are setting records, and popular sentiment is very much that public debt levels no longer matter. Against this backdrop, we are already seeing inflation expectations in the US having fully recovered to pre-pandemic levels, and would not rule out inflation overshooting to the upside in short order as normalization of public life takes hold. The outlook for energy and crude oil in particular remains closely tied to a normalization of economic life. While jet fuel demand ordinarily makes up only 7% of aggregate demand, right now about half of the demand shortfall is due to the collapse of air travel alone. Given the collapse of capital expenditures and restraints on the part of OPEC and Russia when it comes to rising production, this suggests a rather positive price outlook for crude oil if a distribution of vaccine proceeds at the pace that now seems likely. The recovery of industrial metals has been driven mostly by China so far. We see demand broadening out to the rest of the Western world next year with green energy and climate change focused infrastructure programs a major supportive factor. At the individual metal level, the outlook for copper and aluminum remains rather promising with supportive fundamentals. Precious metals have gone into consolidation in recent months as the decline of real interest rate has begun to stall. We believe that repressive monetary policies by central banks will continue into the foreseeable future, thus ensuring continued pressure on real rates. In conjunction with sustained dollar weakness, Therefore, we remain convinced that the upswing of gold prices has further to run. Agricultural commodities have experienced significant price appreciation this year already. Typically, this suggests a supply response in the following season, which might usher in a price correction. However, complicating this picture, there is a high likelihood of an outsized La Nina meteorological constellation next year, which could cause disruption and lower harvest yields. Now, the impact of this is difficult to project, as it depends not only on the strength of the event, but very much also on the exact timing and duration. If you would like to get more insights about our Outlook 2021, please send us a message.